Hi, this is Nikita Burdick with Prosperity Lending, and I wanted to give a market update up until the Fed meeting. We'll have another market update after that. First, on August 26, 2022, the Federal Reserve Chair Jerome Powell gave a speech after the annual Jackson Hole meetings for the Federal Reserve. Shortly after this meeting, we saw mortgage rates and the bond market spike. Why is that? Well, let's take a look at what he said. His speech has been nicknamed the pain speech. Why is that? Well, Powell essentially said that they are trying to accomplish pain management rather than pain avoidance. Specifically, he noted that while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are unfortunate costs to reducing inflation, but a failure to restore price stability would mean far greater pain. While Powell may be correct, how do we feel about this? The Federal Reserve understands that its measures are causing people pain, with higher interest rates, for instance, like home buyers trying to buy a home or qualify, but still feels that it is necessary to push forward to achieve price stability, or in other words, to curb inflation. In fact, that is Powell's main objective, price stability. He mentions that without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Additionally, he claims that we must prioritize long-term economic growth to reduce inflation rather than worry about any short-term pain that people might be feeling because of the Federal Reserve measures. As such, Powell claims that pain will befall on those, but in the end, it is necessary. Powell also alluded to the fact that we will likely be seeing another 75 basis point hike in September. If you remember, in July, we just had a 75 basis point hike, and he alluded to the fact that we're going to see another big measure this month in September on 21st on their meeting. Specifically, he stated, at some point, as the stance of monetary policy tightens further, it will likely become appropriate to slow the pace of increases. Well, so what is he saying there? It will likely become appropriate, meaning that we ain't there yet. Right now, it's still the time for big measures, which means we're probably going to see another 50 basis point hike or 75 basis point hike in September during the meeting on the 21st. In fact, later federal president Loretta Mester was interviewed and used the word pain 9 times after the Powell speech following her chairman, Powell. She also stated that she anticipates the Federal Reserve to be above 4%. The rate is only at 2.5% right now. So even with a 50 basis point hike or a 75 basis point hike in September, we are surely seeing more hikes this year. And potentially, if you remember at the last Federal Reserve meeting, it was mentioned that we might be seeing a few federal hikes to the federal funds rate after this year as well, after they accomplish curbing inflation. Moving on to the September 1st, 2022, the BLS jobs report was released. The initial jobless claims, if you've watched one of my other market updates, what that is, it's people who are applying for unemployment for the first time. Okay, that actually decreased by 5,000, which is now at 232,000. The continuing claims, which means people that are already receiving unemployment and are continuing to receive unemployment, increased by 26,000 for a total of 1.438 million, making it the highest level since April. This is another factor of what led to what the market is doing now. All right, so then we had the Labor Day weekend. Markets were closed, but we open up on Tuesday, September 6th with a very volatile bond market. What happened? Well, the Treasury curve, and particularly the 10-year, had a large sell-off, which sold more than a point which is about 4.5%. Relatively big move for that 10-year position. One thing to keep in mind is that when the treasuries sell off, people are pulling money out, which means the price is going down and causes the coupon rate to increase. All right, now we've talked about this before. When the bond market and the treasury prices increase, what happens to the mortgage rates? They increase. So, what we've seen on yesterday was the mortgage rates drastically increased. We saw a big move. Why is that? Well, why did the treasury market react the way it did? Well, we aren't sure, but there is speculation that it has to do with international issues going on in Europe with the energy crisis. Some are saying that there might be some companies sitting in a very tight position with their future unknown. Today, mortgage rates got a tiny bit better. If you saw on the Mortgage Daily News, yesterday the average mortgage rate was 6.25%. Today they ended at 6.125%. And the Mortgage Daily News, again, for those of you who are not familiar with this website, it takes an average of the different programs that relate their data to them, like Rocket Mortgage or things like that. So it's a good indicator to see where the average lies. We're going to hope that over the next week, the bond market recovers from its drastic open yesterday on Tuesday, and that mortgage rates get a little bit better. For now, that's your market update. Please stay tuned for a market update after the September 21st, 2022 Federal Reserve meeting. That market update will go over anything that has occurred from today, September 7th, 2022, through that meeting. Thank you.